lie they tell you is that the system is safe. They claim the Great Depression was an anomaly, a failure of a bygone era that can never be repeated. They say the guardrails are up, the lessons have been learned, and your money is protected. But what if that protection is nothing more than a carefully constructed cage? What if the very mechanisms designed to prevent a 1929-style crash are now the instruments ensuring your financial ruin? A darkness is gathering over the global economy, a dead eclipse that promises to blot out a century of prosperity. We are not heading for a simple recession. We are on a collision course with a moment so profound, so devastating, that it will not just wipe out paper wealth, it will fundamentally trap the savings of an entire generation. Get ready, because the economic storm of 2026 is not an echo of 1929. It is a meticulously engineered upgrade. To understand the cage being built around us, we must first return to the gilded excesses of the 1920s. This was an age defined by boundless optimism, the belief that the bull market would run forever. The heroes of the time were not inventors or scientists, but speculators. They were buying stock not on value, but on pure, unadulterated hope, fueled by the terrifying magic of margin buying. The average person, the factory worker, the store clerk, could put down a mere 10% and borrow the rest from their broker to buy shares. This was leverage democratized, and it was a catastrophe waiting to happen. The key figure in the shadows, the institution that held the floodgates, was the nascent Federal Reserve. Established years earlier, the Fed was fractured, indecisive, and, critically, beholden to conflicting interests. The New York Fed saw the dangerous speculation, but the Washington board feared that raising interest rates to curb the stock market frenzy would harm legitimate industry and, even worse, put a strain on the fragile global gold standard that tied the world's currencies together. This internal conflict rendered the system paralyzed, allowing the fever to rage unchecked. The government, obsessed with the illusion of perpetual growth and a balanced budget, did nothing to restrain the speculative mania, and the stage was set. The market's peak in September 1929 was not a triumph. It was the final, desperate gasp of a world built on borrowing. The fall was swift, brutal, and historic. When the selling began on Black Thursday, October 24th, 1929, the margin system turned from a rocket booster into a financial demolition ball. As stock prices fell, brokers issued margin calls, demanding investors put up more cash or face liquidation. With no cash available, forced selling began, driving prices even lower, which triggered more margin calls. This was a cascading feedback loop, a destructive chain reaction that wiped out the savings of every leveraged speculator. But the real, systemic problem was not the stock market. It was the banking system. Thousands of small, local banks, lacking federal insurance, had invested in the booming market, and also held mortgage-backed loans that were quickly turning toxic. When people panicked and rushed to withdraw their cash, the infamous bank runs, the banks simply didn't have it. One by one, they folded, not just wiping out investor wealth, but erasing the basic savings of millions of ordinary, non-investing Americans. This destruction of the money supply, cash simply disappearing, is what turned a brutal stock market crash into the decade-long, crippling depression. The problem developed because the leverage was unbound. The banking system was fragile, and the central authority was asleep at the wheel. The price paid was a generation of poverty. Here is the truth no one talks about. The hidden mechanism that makes the 2026 scenario far more insidious than the ghost of 1929. The lesson learned from the Great Depression was not to eliminate financial risk, but to centralize it. After 1929, governments built safety nets, deposit insurance, stricter banking rules, and a Federal Reserve empowered to be the lender of last resort. They eliminated the bank run, but they replaced it with something far more dangerous: the sovereign debt trap. The hidden truth is that the central banks of the world of Fed, the ECB, the BOJ, have spent the last 15 years using quantitative easing and near-zero interest rates to absorb the world's bad debt and inject liquidity. They didn't fix the broken economy. They simply bought it. Now, the debt has not vanished. It has been transferred from the private sector, the reckless speculators of the past, to the public balance sheet. The government is now the ultimate debtor, holding trillions in assets purchased with printed money. When the next crisis hits, they will not be able to print their way out. because the resulting inflation would destroy the value of the very bonds they hold and crash the currency. The real trap is that the safety net they built is now a tripwire. The debt is no longer held in a fragmented banking system that can be allowed to fail. It is held by the state, and if the state fails, everything goes. The immediate fallout of the 2026 correction will not be a sudden, sharp deflationary collapse like 1929, but a slow, agonizing stagflationary decay. When the modern bubbles burst, be it in the overvalued technology sector, the commercial real estate market, or the sovereign bond market itself, governments will be faced with a choice. Allow the debt to be liquidated, triggering a depression that rivals the 1930s, or intervene with a new, aggressive form of monetary policy. They will choose intervention. The market's fear will force the hand of the central banks, leading to a desperate attempt to cap interest rates and restart the printing presses. This injection of capital will not flow into productive investment. However, it will flow directly into inflation, eroding the value of every dollar, pound, and euro. The stock market will be volatile, but may avoid a complete 1929-style wipeout, only because the cost of the crash will be paid elsewhere. The biggest losers will be those holding cash savings, pensions, and fixed income assets. The winners, those who hold real, physical, and productive assets, hard money, real estate outside of commercial, and commodities. The ordinary person's savings will not be physically lost in a bank failure, but they will be trapped and slowly liquidated by a centrally manufactured inflation that shrinks purchasing power day by day. This is the government choosing financial repression to solve a debt crisis they engineered. The parallels are not just eerie, they are a signpost for the coming disaster. In 1929, it was the rampant speculation in public utilities and the excess of margin debt that created the volatility. Today, it is the unprecedented level of corporate debt and the leveraged mania in the private markets. Companies today are borrowing at rates last seen before the previous great crashes, and they are doing so to fund stock buybacks and speculative projects that have not yet generated a dollar of profit. The CAPE ratio, a long-term valuation metric, currently sits at a level higher than every point in history except for the peak of the 2000 dot-com bubble. In 1929, the bubble was in radio and utility stocks. Today, it is in artificial intelligence and highly concentrated, monopolistic tech giants. But the most shocking similarity is the complacency. Just as economist Irving Fisher famously proclaimed in October 1929 that stocks had reached a permanently high plateau, modern financial commentators assure us that this time is different due to the power of the central bank. They forget that the power of the central bank is finite. Today's debt is an order of magnitude larger. The 1929 debt was a simple mortgage on the American house. The 2026 debt is a global derivative chain reaction wrapped in a layer of central bank promises. The audience should care right now because the price of this complacency is the slow, silent theft of every dollar you have set aside for your future. Our prediction for the next 6 to 12 months is not an instant crash, but a grinding economic siege. We anticipate a major, coordinated shift in sentiment beginning in the spring of 2026. This will be triggered by one of two events: either a sovereign debt default in a major G7 nation outside of the US, or a sharp unexpected increase in the unemployment rate as the wave of high corporate debt defaults begins. The central banks, trapped between the deflationary pull of the debt bubble and the inflationary pressure of their previous money printing, will panic. They will implement a form of yield curve control, an emergency policy, to cap long-term government bond rates. This action will be framed as necessary to save the economy, but its true effect will be to nationalize the bond market and monetize the debt. This move will confirm the end of free market capitalism as we know it, sending a powerful, irreversible signal that the age of fiat currency is in its final chapter. Your savings, while technically accessible, will have their purchasing power aggressively targeted by a new structural inflation that makes a $10 gallon of milk a near-term inevitability. In 1929, the victims saw their savings vanish overnight, wiped out by a tidal wave of bankruptcies and bank failures. In 2026, you will not experience that sudden, merciful shock. Instead, you will watch your wealth, the product of decades of labor, be quietly, systemically drained away by the insidious current of inflation, a tool wielded by institutions sworn to protect you. The house of cards will not collapse. It will simply be inflated away. Its value dispersed into the hands of those who control the printing press and own the real assets. They built a cage of debt and called it a safety net. The only escape is not to fight the system, but to understand the rules of the trap. The lesson of 1929 was vigilance. The warning of 2026 is this: you cannot save your way to prosperity in a system that makes the rules for money as it goes along. The clock is ticking. What are you holding on to that they can take?